Welcome to Street Smart Live. My name's Gordon Holmes. I'm the founder and today's host. I'm very excited to have you all here. Before I introduce today's featured guest, Adrian Day, I want you to all review the important disclosures on the screen in front of you. I'm sure you've seen these before. It says who owns what, who has a financial relationship, all that sort of stuff. All right. Adrian Day is the founder, president, and portfolio manager at Adrian Day Asset Management. He is with me here in Puerto Rico. We both live here. Full disclosure, I've been a client of Adrian Day for probably 20 years. So like you, I'm very excited to hear what he has to say today about the precious metals market and to meet some companies he thinks we should be investing in. So without further ado, Adrian, welcome aboard.
Well, thank you very much, Gordon, and thank you for inviting me to do the first of what we hope will be a long series of exciting Streetwise Live shows. And as I say, this will be the first of a series, I hope. And I thought for the first one, we should look at royalty companies. I think anyone who knows me knows that I've been a big fan of the royalty sector for a long time. In fact, I first bought Franco-Nevada in 1985, long time ago. And as we know, as a group, I'm not talking about individual companies because the SEC doesn't let me, but as a group, the royalty companies have performed exceedingly well over the last 10 years. And I've invited onto the first show three, what I call emerging royalty companies. And they're all different. Two of them, in fact, only went public in the last few months, although one of them was private for several years before that. Market cap ranges from 800 million down to 60, 65 million market cap. And they all take a slightly different approach to the acquisition of royalties and streams. So we've got all in the basic same industry, same sector, but all taking a different approach. Let me just explain the format today, if I may. I'm going to give a brief talk on royalty companies, what royalty companies are, the benefits, and indeed the disadvantages of royalty companies over mining companies. When I've finished, each of the three companies will give a presentation on their company. And at the end, we'll open it up to questions and a general discussion. And I hope we'll have some lively debate. And also, you listening are able to send in your questions. There's a little thing on the right side of your screen where you can type in your question and send it. And we'll try to get to as many of those as possible. So let me just introduce the speakers, and then I'll give my talk. They're all the CEOs of their companies. We have Vincent Metcalf, who's the CEO of Nomad Royalties. We've got Frederick Bell, who's the CEO of Elemental Royalties. And then we've got Dave Cole, who's the CEO of Eurasian, or sorry, EMX. I keep calling you Eurasian, David. Old habits die hard. Glad you've got a shirt and tie on, David. I'm glad somebody style around here. So I'm going to give a quick overview of royalties, and then in the discussion at the end, I'm sure some of you will want to disagree with some of the things I've said. But the first thing is a disclosure. Nothing I say is meant to in any way reflect on past performance of companies that we own. So I'm going to start by sort of backwards a little bit. I'll start by looking at mining companies and what the problems with mining companies are. I think we all know that mining, or if we don't, it's important we understand mining of anything, not just gold, is an inherently difficult business. Bob Friedland likes to say that Murphy works overtime in the mining business. Anything that can go wrong and more probably will go wrong. But the biggest problems in the mining business, obviously, you're producing a depleting asset. So unlike producing widgets where you can just build another factory, ramp up your production or whatever, with mining, every ounce of gold you produce is gone. So a related problem, of course, is that you have to replace those ounces. And the truth is that we as an industry worldwide are simply not making sufficient discoveries to replace those ounces. And that's why you have a lot of M&A in the mining business. It comes and goes. And why, frankly, sometimes companies overpay for marginal assets. This was very true 10 years ago. Why they overpay for marginal assets because they have to replace those ounces. I mentioned here high costs, and I'll just mention what I mean by that. Typically, when the gold price goes up, the price of what these companies are producing, so too does the cost of other resources, including oil, including energy. And oil represents about 30 to 35% of the cost of any mining operation. The second thing that happens is the currencies, what we call the commodity currencies, Australian dollar, Brazilian real, Canadian dollar, and so on. The currencies of countries where most mines are located, they also tend to go up in a bull market. So you have the situation where even though the price of gold is going up, so too are all of the input costs, including the cost of building and the cost of operating mines. And so we had the very unfortunate and ironic situation, if you like, for 3 years in the early 2000s, even though the price of gold doubled, so too did all of the cost inputs, and the margins hardly expanded at all. And the result of all of this is that companies had losses. The mining companies have losses more often than they have gains. I should just mention right now on the cost basis, on the cost factor, we're actually in a very fortunate or very unusual situation now where the stars are aligned and the price of gold has gone up, whereas the price of oil, of course, has gone down 35% this year or whatever. And the commodity currencies, even though they've gone up a little bit, have not kept up with the price of gold. So that factor doesn't apply right now. Let's look at reserve depletion. We had a pickup in stated reserves last year, but we're still down over 30% from the peak in 2013, which of course means that reserves have to go up by 50% just to get back to where they were in 2012. And unfortunately, despite spending on looking for gold exploration budgets worldwide, they had a spike in 2012-13, but apart from the spike, we are now spending as much as we ever have looking for gold. And the new gold discoveries are those dark blue lines. That is not a lot. It's certainly not a lot in relation to existing reserves, but it's not even a lot in relation to production. Again, we are not finding what we are producing as an industry. And so it's not surprising that the return on equity for precious metal mining companies is not particularly strong. You know, it's a quarter of what the overall market is. This is return on equity. And in fact, last year for precious metal mining companies, the return on equity was negative. And if you look at 50 years, return on equity for gold mining companies has been negative. In other words, they've destroyed capital, not created, destroyed wealth, destroyed capital, not created capital as an industry. The record is second only to the airline industry. And so not surprisingly, with this sort of thing, we see the stocks do this. Yes, they've gone up a lot this year, of course, but also since the bottom in early 2016. But they are still not only well below the highs in 2011-12, but this is the XAU, the Index of Leading North American Gold and Silver Companies. It's lower today than it was in 2006. In fact, it's lower today than it was in 1986. So both as an industry or as a business and also as an investment, mining companies have not been particularly attractive on a long-term basis. Now, generally speaking, I don't like saying I like something because I don't like everything else. So let me just say that I like royalty companies in and of themselves. But you can see that with these kind of difficulties, and a lot of them are inherent, inherent difficulties in the mining business, the royalty companies begin to look very, very attractive at all. This slide I've taken, a lot of you have seen this, a lot of you have done something very similar with your own companies, but I took this from Franco-Nevada. I'm going to refer to Franco-Nevada, A, because it's the oldest gold royalty company, it's the largest gold royalty company, and it's not here, so I don't think I'll offend any of you three by mentioning them as opposed to, picking and choosing who else I mention. But if you look at royalty companies and compare them with gold bullion or gold ETFs, you see that the dividend yields are obviously higher. They have leverage to the gold price, which gold doesn't, of course, by its nature. It doesn't have leverage to the gold price unless you buy it on margin, which I don't recommend. And with gold, there's no exploration upside, again, pretty obviously. Now, if you compare royalty companies with operators, you see they have reduced exposure to capital cost, operating costs, environmental costs, and so on. And that's a key point to royalty companies. Now, a lot of royalty companies will do, there'll be little twists in the structure of royalties. Like Franco-Nevada's big royalty on Cobre Panama was staged so that they made various payments as hurdles were met. And there's a lot of examples of that, of course. But typically, when a royalty company says, we will pay you X, whether it's immediately or over a number of years, for Y% of your future production, that's the end of their exposure. And they're not responsible if things go wrong. They're not responsible if the government wants to increase the tax or NGOs, start protesting against the project. And so that's the beauty. They have reduced exposure to all of these unforeseeable, both foreseeable and unforeseeable cost increases. Now, the result of all of this is the XAU again, and you can see that for most of the last 10 years, the XAU companies in aggregate have lost money. This is Franco-Nevada. Again, I'm mentioning Franco because I hope it doesn't upset anyone here. They've had a few quarters with losses, and frankly, most of those quarters were extraordinary losses, currency losses, write-downs or whatever else it was. But for more quarters than not, they've made money. And one of the reasons for that, is that royalty companies can operate with royalty companies tend to have, much lower G&A than operating companies. I mean, by the nature of the business, they can do that. And so you see, this is Franco-Nevada again, but last year, less than 8% of their cash flow went on G&A, which is pretty low. Again, one other comparison would be debt. This is the debt of operating companies. And again, by their nature, mining is capital intensive. And so by its nature, by their nature, mining companies have to, more often than not, raise debt equity in order to build new mines and expand new mines. Royalty companies don't have to do that. Again, Franco has had debt in 2 quarters, and in each time they paid it off within 2 quarters, completely paid off. And so this just shows you again the sort of result. This is Newmont's cash from operations. I think the trend is not in the right direction. And this is Franco's cash from operations, up and down, but the trend is in the right direction. Now, I could have put Eurasian up here, and it would, or EMX, I'm sorry, but that wouldn't be fair to the other two, but the graph would look much the same. Now, just before I close, disadvantages, and we'll talk about some of this in the panel, I think. First major disadvantage is the obvious one, that other people control the asset. You give them money to build a mine, and in return you get a royalty, but you don't control when they build the mine. You don't control a lot of royalties, as you probably know, might be only on part of a deposit. There might be 3 or 4 different landowners originally that each have a royalty on a deposit that covers 4 different pieces of land. And the mining company might decide, well, we're going to start mining east, where your royalty is on the western end, for example. You don't control that kind of thing. The second thing is the royalties and streams can burden projects. This was obviously more true when the price of gold was going down and was weak. But when you've got royalties and streams combined at 25% on a project, it's very, very difficult to make that work. Now, some of these things have been mitigated by royalty companies recently, particularly the bigger ones that have more, bargaining power. But a lot of royalties and streams now will have a clause that if this particular project doesn't come into production by a certain date, then the company has to give a certain amount of money from its other mines, for example. And a lot of royalty companies have been willing to renegotiate the terms of royalties when it's clear that they do encumber the project, because clearly it's better for a royalty company to get 1% of something than 5% of nothing. The last 2 things relate more to people's perception, I think. A lot of people say royalty companies don't have any leverage, and I'm sure the 3 companies today will explain to us why that just isn't true. It's absolutely not true. Of course, the first thing is when the price of gold goes up, the revenue that they receive from a royalty goes up. But that's not where the leverage comes in. The leverage comes in from having a royalty that you bought in 2006, and without having paid another penny, the mine comes into production in 2021. Now, I call that leverage. There's leverage from mining companies that decide to do brownfields exploration. If you have a royalty on that land around the mine, and a lot of mining companies, a lot of royalty companies make sure that they get the land around the mine as well. And then that's leverage, because you're not paying any more money for the exploration and development that the mining company puts in. Lastly, I hear it all the time from people. These stocks are so expensive. I don't know why you recommend royalty companies, Adrian. They're just so expensive. Look at this, that, or the other, trading at 60 times earnings. I don't think anyone's ever going to confuse, Franco-Nevada and Royal Gold and Wheaton, the big ones, with Graham and Dodd value investments. But I'll say 2 things on this. I'll say 3 things. Number 1, the royalty companies justify higher multiples because of their more consistent outlook than mining companies and their low risk model. So because of that, they justify higher multiples. Secondly, they have always traded at higher multiples. Now, does that make it right? Not necessarily. We know things can change, but the royalty sector's been around now for over 30 years. and they have always traded at extremely high multiples. I think those multiples are justified. But the last thing I'll say is, even though the big three, Franco, Wheaton, and Royal, trade at high multiples, the companies we have here today are not trading at high multiples at all. And this, in my view, is your opportunity to get into these companies early, very early in two cases, early in one case, when they still are inexpensive and when they have the potential to develop strongly over the next 4 or 5 years. And as they grow, the multiples will expand. That's been the history with the other companies. There's no reason to think it won't be the history with these companies. If they execute, if they grow, the multiples will expand. And that's another disclosure, because lawyers can't get enough of disclosures. Oh, I am sorry about the coughing. So that's the end of my presentation. The first speaker that we have is Vincent Metcalf, who's founder and CEO of Nomad Royalties. So over to you, Vincent.
Adrian, thank you very much for that presentation. Obviously very informative, and thank you very much, Gordon, for inviting us to Street Smart Live, and hopefully it's one of many events that we're able to attend. So today I'm going to be talking about Nomad Royalty Company. Before we dive into the presentation, I would say that we're obviously one of the newest royalty and streaming companies in the sector. We've been trading for just under 4 months. And obviously it's been a pretty good backdrop with the gold price and silver prices doing so well. We currently have 12 different assets, 6 of which are in cash flow. And, we have a very aggressive pipeline to keep growing the business and really keep diversifying that risk, within the portfolio, and by adding new assets on a very regular basis. So, Ron, if you could put the present, perfect, thank you. Okay, so Nomad. So I would say most importantly is the team behind, and I think with all 3 companies here, I think this will be a common theme, is the team behind these businesses are obviously one of the better assets within these royalty and streaming companies. The ability to be able to attract new assets, new royalties, new streams is something that's very important for any type of royalty companies that are in business. The ability to structure new deals, the ability to evaluate and be really efficient in the ways that you approach these opportunities is very important. So Joseph, Elif, and myself have been together pretty much for the better part of the last 6 years. We joined, together in founding this company. We led the efforts for another royalty companies, from basically the ground up, so very similar size at which we started this business. And obviously, I think that's the important thing with Nomad to understand, is that this team, there's no ramp up issues. This is what we know. This is what we do. We've learned from the past. We've learned from the different companies in the sector, and we have a very, very I would say structured approach and precise approach on how we want to build this business. That also reflects very well on our board of directors. We have a few representatives of the initial vendors of portfolio. Nomad came together by vending in 2 portfolios, one by Orion Mine Finance, another one by Yamana Gold. So we have 2 representatives, Istvan and Gerardo, on our board. We have a few more board members, between Premier, Matt Golat from Premier Gold, Jamie Porter from Alamos, and Robin Wiseman from B2 Gold. All very, mining savvy people with a very, very good background in transactions. And recently we've added Susan Kudzman, who essentially worked in risk management her entire career, and is going to be very helpful when, looking at these different types of transaction and opportunities. So important to think, when looking at Nomad, we're building on our experience. This is a new royalty company, but obviously a very experienced team. The way we're going to approach at building our portfolio is maintaining as much diversification as possible. Adrian pointed out, the business, the royalty business is limiting risk, and you got to mitigate risk, and risk takes a lot of different forms. You have concentration risk in terms of jurisdiction, in terms of operation, in terms of different type of commodities. In our case, we want to make sure that we focus on gold and silver, and we want to make sure that we build a very, very diversified portfolio, so that in 2 or 3 years, when we look back at where we are today, we were looking at a portfolio of 30 different assets, with not one asset representing maybe more than 1 or 5 or 10% of overall cash flow or overall NAV within the portfolio. So that's very important for us. We think the more we diversify in different jurisdictions, the more we diversify in different operations, the more you limit that risk and the more you limit that volatility. At the end of the day, we're not operators. We are, essentially portfolio managers. So we want to make sure that that is something that's very important for us. The two other main pillars when building this business for us is committing to very low G&A and leading with a very high dividend. We just announced our dividend policy a month ago. We're currently paying a yield of around 1.3, 1.4%, which is about double the average in the sector. And that's really just a starting point. We're looking to build on that. It's very important for us to keep, returning capital to shareholders and investors. And going back to my point, because we see the low G&A and that high dividend kind of go hand in hand. The more we limit, the G&A, the more we're able to return, or the more we're able to reinvest in the assets, in the different opportunities. In terms of why Nomad? Well, we're a team that's done it before. It's a ground floor opportunity. We've only been trading for just over 4 months. It's 100% gold and silver. It's 6 cash flowing assets at the moment, located very globally around the world. Low cost, so we're looking at 77% life of mine in terms of margins at the moment. And we've already announced 3 new acquisitions since the beginning of trading, and that's going to keep on going. This is a slide that we're obviously very, very happy, in terms of the things that we were able to execute since the beginning of Nomad. We've completed a lot of different milestones. These were exactly the same goals that we put forward, the day before trading. And having been able to complete all of these, over the last 3-4 months was very important. One of the main things I would say that, definitely differentiates us from maybe some of the newcomers is that ability to borrow. We've just put a revolving credit facility of up to $75 million in place. And that's going to give us even more optionality and even more opportunity to put new streams together or buy new royalties in the market. So that's definitely something that we're very happy with, and we're going to keep on building on the liquidity and the market awareness. So where we are today, we're a market cap of around $615 million US, or 820 million Canadian. We've got obviously very big shareholders at the moment. The 2 initial vendors being Orion and Yamana at 75 and 12%. We've just started getting some research coverage recently by Industrial, Cormark, and Velocity. So very happy to be to start getting some coverage on that front. And obviously, we're very happy to have had Adrian's support when creating this business. And obviously, we're going to keep working on adding new shareholders to the registry. In terms of the portfolio, obviously we have assets all around the world. And as I said before, as we grow this business, hopefully in 3 years, we look back at that map and there's a lot more areas which are covered. We strongly believe that by being in more jurisdiction, the more it actually diminishes the volatility of our portfolio. Even the top jurisdictions, whether they're Australia, Quebec, where we live, they've all been hit with tax regime changes in the last few years. So even if you're in a top mining jurisdiction, it doesn't mean that you're actually protected against those changes. So we actually prefer to really limit ourselves and really make sure that we are in a lot of different jurisdictions, so that we don't have one specific concentration risk. So where we're at the moment, in terms of the portfolio, about 50% of our value is in production. 100%, gold and silver, 23% silver, 77% gold at the moment. The interesting thing, if we go back to the asset stages, we have another 37% of value, which will be coming in production within the next 12 months. So at that point, we'll be in a position where between 75 and 85% of our value is in cash flow, and that's very, very important for us. We wanted to build a business that was able to capture the increases in gold prices and silver prices. This is a very cyclical business. If you're able to have a portfolio or a vehicle that's able to capture that increase in gold price and return those amounts of cash flow and that capital back to your shareholders, we strongly believe that that's what's really going to fuel higher multiples down the road. In terms of the royalty sector today, I think we'll be able to cover some of this, so I won't spend too much time, but we'll be able probably to talk about this in the panel. But obviously, the sector's gone from being a $2 billion market to a $75 billion market at the moment. So there's obviously a lot more interest from the investors, and we strongly believe that this is a market that keeps on growing. And obviously, with the lower risk profile of the royalties, we will keep seeing some new inflows on the from the investor front. In terms of how we're going to build our business, right now we're a sub $1 billion company. Our goal within the next 2 to 3 years is to get to that $3 to $5 billion company, to get those higher multiples that Adrian was talking about. Right now, we have a multiple which we would qualify being a junior to mid cap royalty company. But when you look at the big threes, as Adrian was pointing out, you're looking at double the multiples or the valuation. So we're going to be looking at doing partnerships, co-investments with other companies. We'll look at doing M&A. We've announced an acquisition of Coral Gold last month. So those are two of the I would say the branches that we're going to be putting forward to make sure that we keep growing. So lastly, I would say right now the main things for us is to scale up, keep diversifying that portfolio, making sure that the assets that we're adding don't represent too much of the overall portfolio. We want to make sure, as I said, that within the next 2 to 3 years, we have a portfolio with assets that don't represent more than, say, 10 or 15% of the overall overall exposure within the portfolio. It's very important for us. Obviously, maintain very low G&A. The management this year is all taking shares. We're not taking cash salaries at the moment. It's very important for us to maintain, being aligned with investors, and that's very important for us to make sure that every question, every decision that we take as Nomad management is as a shareholder first type reaction. So executing on a very simple strategy, focused on precious metals, and I would say that on that point, I'm happy to pass on the discussion to, I believe, Fred.
Dave, thank you very much, Vincent. Yeah, Dave Cole is next. We're going in market cap order downwards. But David Cole is the CEO of Eurasia, of EMX. I'm sorry, they used to be called Eurasian. It's now EMX Royalties. And we should give symbols as well, by the way. Nomad is NSR on Toronto. I don't know what it is, OTC, frankly. I'll look it up while we're talking. But I
NSR XF.
Okay. I always buy on Toronto because it's more liquid. EMX trades on New York, so the symbol is EMX, and EMX is the longest of the public companies that we have here. So over to you, David.
Yeah, thank you, and just want to make sure that everybody can see the screen here that I'm flopping through. Can everybody see this?
Yep.
You're having some issues with the screen share.
Okay, I don't see your slides, David. Is Ron there? Can you help him?
So we've been struggling with this. We've done the various steps that it shows that we're supposed to do, and it's not showing up. So
does Ron have to launch it?
Screen change?
Not usually. David, so you clicked on square sheet screen, and then you saw the on your computer, and then you click the one you want. So it should come up.
Yeah.
Just click back there.
We're right here. Right here.
Yep.
Mm-hmm.
Do it again, screen share.
Try it again.
Yep.
Yeah.
Share
We're,
screen.
and
Again, Adrian, if you want to switch
window.
to
Yeah, shall we go over to, thank you, Gordon. Let's go over to Frederick Bell, who's the CEO of Elemental from London, or from England, I should say, not from London. And are you prepared, Frederick?
your
You hope so. Okay.
mute on. Your mute
So-
on. There you go. You have
You're on mute, Fred.
You're on mute. Fred, you're on mute.
Brilliant. There we go. Thank you. Should be okay here if I look to load up the presentation, and I will share my screen with everyone. And just give me 1 second, and I can share this, and we should be going live. And if you let me know when you can see that.
We can see it. We can see it. Thank you.
Fantastic. Okay, well, thank you very much for the introduction. And I think grateful likewise for putting this together, and particularly Adrian, I'm very grateful for investors like you, I think, who do their homework before investing. And I believe if you do your homework, you will come to the conclusion that Elemental is a excellent value proposition. And we are a very new company on the exchange, so disclaimer here. But we listed on the 30th of July on the TSXV with the symbol ELE, E-L-E. And so we've been listed as of yesterday, about 2 months exactly. So we are really one of the newest companies to the royalty space. And when you look at the first slide here, I think what we really try and highlight is the fact that we are a small but fast growing precious metals focused royalty company. So from 2017 to 2020, we have doubled the revenue year on year as we have grown. We have today a portfolio of 6 royalties with 5 over operating assets. We have one of the royalties that will start to pay us in 2022. So without doing anything else at all, we have growth already in the portfolio. And looking at it today, we have about a bit over $5 million gross revenue for 2022. And in terms of the team and management, one of the things that we normally say is that although we're new to the market, we're not new to the royalty space. And we have been doing this for the last 3 years as a private company. And that meant that we were able to build a really good track record coming into the market. We were able to get the critical mass and put together a really strong proposition. And management team to date, as a result of focusing on good quality producing royalties, we've been able to limit the dilution. And so we still have about 25%, just under, of the company to date. And one important point to note as well on the royalties, and it's always important for royalty investors, is we have all the royalties are uncapped and there's no buybacks on any of them. So moving on to the next slide here. And this is a point that is always important for royalty investors, and a critical part of the model is as you grow, you get more diversification and you lower your risk profile. And so we're 90% precious metals weighted now, and that is an area we'll focus on. And we're very heavily weighted towards assets over producing royalties. But already as a very small company, we have 6 different operators, and we have royalties in 5 different countries. And that really helps us in terms of minimizing the jurisdiction risk, minimizing the single operator counterparty risk, while still giving us really good exposure to precious metals prices through the operating assets and through precious metals themselves. So going on to the next slide here. When Adrian spoke earlier in his introduction, I think one of the things, 2 of the points he made is that you're looking for an inexpensive royalty company that has a potential to grow. And I think that is exactly what Elemental is. We have, as I mentioned earlier, on forecast 5.3 million revenue, gross revenue for 2020 in US dollar terms. And when you take out our existing cash, we have an enterprise value of $37 million. So we're trading at a really big discount to the other royalty companies. And I think part of that is a function of being so new to the market. We're still raising awareness, educating, but I think it puts us as the best value royalty company out there. And for a royalty company that for the past 3 years has delivered not just growth in terms of royalties, but growth in revenue, which is the ultimate metric, 100% year on year, to be trading at under 10 times revenue, to have an enterprise value so far below, a lot of our peers, I think puts us in a really good position. And the management are incentivized, I think, more so than almost any other royalty company with a 24% stake. And we have a very large institutional holding for a company our size as well. And in the last 3 fundraisings, each time we have increased the number of institutional shareholders. So I think that's really important as well. If you come on to the next slide here, this is an overview of the management team. And there are 4 directors on the board and three of us here in London and Richard in Australia. So a pretty global team in terms of where we are located. And I think that brings us a lot of access to deal flow from different countries. And with a good blend of commercial experience, technical experience, market, financial experience. And if you look at the team in London, where I am now, I think the average age of the core team of the 3 of us is sort of mid-30s. And so we are really hungry, really motivated, a good track record, and we've never had a better foundation to grow the company than where we are today. And coming on to the next slide here, slide 7. This is a quick timeline. And normally do this to give some background and just transparency. So you can see we made our first acquisitions in 2017, and then in 2018, and then at the start of 2020, our last one. And I think one of the aspects I would bring out of this is that we have increased the size of the deal as we have grown the company. And Elemental was a startup royalty company. So we actually gave away 50% of our first royalty acquisition. We syndicated it with a fund to get the deal done. And so I think we have definitely proven our mettle the hard way. And if you look at first acquisition, $1 million, then $4.5 million, the last one, $12.5 million US. And for the first time being able to use debt to part finance that acquisition, I think it demonstrates that as we go forwards, we can continue to really grow the company. And the platform we have now with more revenue than we've ever had, more cash in the bank than we've ever had, and an ability to access debt similar to our last acquisition, it puts us in a really good place. And most of all of these royalties we acquired to date were third-party royalties. And I think that has been a common theme in a lot of the acquisitions we have looked at in the past and the ones we're looking at going forwards. And I think it has enabled us to get a really good value purchases as we have grown. If you look at this next slide here, this is just a quick example of when we talk about not just growth in size and scale and revenue, but growth in shareholder returns. And as of the last closing price of Elemental shares, you'll see that every time we have done a fundraise, we have raised money at a higher price than we did before. And we have done only 6 royalty acquisitions to date, but all of them have been material acquisitions that have moved the needle in terms of price and value. And I think that has been a common theme that we're taking forwards. This is a quick overview of where the royalties are to give you an idea geographically, and we're pretty diverse in terms of geographies and countries. I think one other point we would normally highlight on this slide is that we go from anywhere from a 0.25% up to a 2.25% royalty. And our view has been that it's better to have a smaller royalty over a good quality asset with a good management team and good operators than trying to go for a 4 or 5% royalty on a very small asset, which typically has more risks. One other aspect, and I think Adrian touched on it again in his introduction to the royalty model, is a key part of royalty companies trading at a better valuation is the fact that you get the benefit of exploration upside going forwards and optionality without having to pay to develop those resources. And I think it's really it speaks to some of the quality of the assets we have from the outset, that 2 of them cover genuinely district scale land packages. And I think, if you look at some of our larger peers who have been around 10 years plus, they may have 2 or 3 district scale royalties, being billion-dollar plus companies. And I think where we sit today, we're coming into the market just listed. We have been, increasing the size of acquisitions as we go, and we already have a really good foundation of producing royalties with exploration optionality moving forwards. This here is it's just a bit more detail on the revenue, which we mentioned, and you can see that just going forwards, we have revenue growth without having to do anything, without any new acquisitions. But if you look at what we have actually achieved since we started, every year we have made material acquisitions and materially increased the revenue. And as I mentioned, I think this is a really good foundation with the listing to be able to keep adding value that way. The second tenet that Adrian mentioned at the beginning was inexpensive. And typically you're paying premiums for royalty companies because the model is so successful and because companies have a very good track record of managing to add value as they grow. And that's why I think today Elemental is such an attractive opportunity, because we're brand new to the market. We're trading for a royalty portfolio that is almost exclusively weighted towards royalties over operating assets. We're trading at a discount to even those companies that have predominantly explorational development assets. And so I think as an entry point, Elemental today is one of the best you'll get. And this touches on the point I mentioned as well around the focus on producing assets, which enables us to use some of our revenue to cover costs. Not only that, but to use it to reinvest into new royalty acquisitions. And Elemental, from inception to date, has been a cash flow positive business every single year. And so if we're raising money, we're doing it to make an acquisition which we believe will add further value for shareholders. In terms of the pipeline, one of the key aspects for a royalty company, how are we going to continue to grow it? How are we going to build out the portfolio? And I think the main advantage we have is that we have a track record for 3 years of doing this the hard way from a startup company. So we have relationships, we have opportunities we've seen in the past that didn't fit when we were smaller, but I think do now. And I think that with more cash in the bank and equity, which we can use as a currency for the first time following the listing, I think it puts us in the best position we've been in to be able to execute on that strategy. And I think it's not just individual royalties, which we've talked a bit about so far. I think it's also portfolios of royalties. And you can see in the past that when some of the majors and mid-tiers in the mining industry have sold precious metals portfolios into companies for equity, they have managed to see a very good return from that. And Elemental, as it stands today, is I think the best vehicle for a company like that to realize the maximum value through. The next slide is taking two peers and recently listed, and I think that in terms of their performance following listing to date, I think they have both demonstrated an ability to keep growing that portfolio and adding value. And I think where Elemental came in when we listed was we had more producing royalties than either of those companies, we had more revenue than either of those companies, but we were coming in at a market cap that was half of the of the larger one. And so I think that today, that is the opportunity we present. And this probably follows on from the point Adrian made on the value that royalty companies have generated generally. So I won't dwell too much on it. And I will instead sum up here by saying that if you invest in Elemental today, you're coming in at the ground floor. We've been listed for 2 months. We're trading at the best valuation of the royalty companies with a portfolio that is underpinned by good quality, cash generating, precious metals royalties. We've been cash flow positive from the outset. And if we're going back to the market to raise more money, we will be doing it because we are making a meaningful acquisition that should change the value proposition for Elemental going forward. And that is a quick summary of the company.
Well, thank you very much, Frederick. Again, you saw his symbol there, ELE in Canada. In the States, it's on OTC, it's ELEMF, M as in Mary, MF. Again, I always prefer to buy stocks that are listed in Canada, or wherever they're listed, rather than on the OTC. But I know some discount brokers, some online brokers, you can't do that. So now we'll go to the third and last of the presenters, David Cole, CEO of EMX. David, over to you.
Thank you very much. And can everybody see my screen now?
Yeah, no.
You got the PowerPoint presentation working? We got a confirmation from Ron that it was working a second ago. And special thanks out to Frederick for covering while we figured out our technical issues. Is that working, Adrian?
I'm sorry, David, we're not seeing it.
Uh-oh. So you know what I can do, Adrian, is I can just simply talk about the company without the PowerPoint presentation. That's not a problem. And if you prefer that, I'll go ahead.
Yeah, I think that's better. And while you're talking, Ron will try to see if he can fix it at his end.
Yeah. Okay. Sure. And I'll be paging through it on my end. But yeah, thanks again, Frederick, for covering, and Adrian, great discussion on the royalty model and its power. I'll just add a couple of pour some more fuel on the fire, if you don't mind. You know, royalties are phenomenal financial instruments. And it's because it's interesting. You look at a number of different royalty companies that have approached the space differently, and they've all been very successful, or a significant number of them have been very successful. And from my perspective, that's an interesting data point. It speaks to the fact that the financial instrument itself that is being accumulated by these companies is something special. And that special aspect really boils down to optionality, commodity price optionality, of course, which has been favorable over the long haul. But also very significantly would be discovery optionality. And there's other aspects of the optionality that people don't often talk about. That would be engineering advancements, better mining engineering techniques that allow them to mine underground in Nevada, whereas previously they couldn't because of rock quality is an important one with respect to the value of gold royalties in Nevada today compared to in the past. Also new metallurgical advancements that enable gold to be recovered that was not recoverable in the past. And all of these different aspects of optionality and technical advancement within the mining space are multiplicative with respect to the power of wealth creation for the royalty holder. As cutoff grades are decreased because of increased commodity prices, better engineering techniques, that just is a huge win for the royalty holder. And that's put Franco, you used Franco as the preeminent example, Adrian, which I would concur with. You take the company making asset that they have in their portfolio. The first one that really excelled them is the royalty that they purchased on the Gold Strike mine. The Gold Strike mine, when they purchased that royalty, was a fairly ratty, small deposit, wasn't perceived as being a tier one asset. Thanks to these different aspects of optionality, they paid $1.x million to buy that. It was actually advertised in the Reno Gazette Journal, of all places. And now, decades later, that has cumulatively paid close to $1 billion and is still paying. And that's a fantastic example. Of course, they're not going to all be that successful, but it speaks to the value of the financial instrument that's embedded in a royalty. Now, I mentioned that lots of folks take a different viewpoint with respect to how to build a portfolio of royalties. And definitely ours at EMX Royalty Corporation is different than the rest of the group. Our true bread and butter with respect to how we build a royalty portfolio is through royalty generation, as opposed to mine finance and buying royalties. That can be an expensive way to buy royalties. Royalty acquisition of third-party royalties, that can also be quite expensive. We do those as well, but our core bread and butter approach is through royalty generation, where we acquire large tracts of prospective mineral real estate around the world, add value by building economic geologic models, sell those assets on to an industry hungry for discovery opportunities in exchange for share payments, cash payments, annual advanced minimum royalty payments, stage gate payments, and always a production royalty at the end of the day. We've sold 50 projects in the last 2.5 years, creating 50 new royalties through execution of that. And we have definitive evidence that long-term, this is the most astute allocation of capital in the sector. we're growing these royalties exceedingly inexpensively. However, it's a very slow process for those to advance and become significantly cash flowing. And when you invest in EMX today, you're taking advantage of 17 years of royalty generation within our portfolio. We also buy royalties and only if and when that they're attractively priced. Our threshold with respect to the amount of money that we're willing to allocate towards acquisition of royalties is different than our competitors. They're willing to pay up, and in some cases that's done well for them. But we're value players in a momentum world, and we are focused on astute allocation of capital. We only buy royalty portfolios or individual third-party royalties when we're quite confident, based upon dominantly our geologic interpretation of the discovery potential, that those are distinctly accretive acquisitions. The third thing that we do, Adrian, and for the whole group that makes us unique, is we make strategic investments. The same team of economic geologists and business people working around the world developing our portfolio identify acquisitions, royalty acquisitions, whilst they're doing the royalty generation process, and they also identify strategic investments. And our threshold is you only buy stock at another company if we cannot not buy the stock. And we've had a dozen different strategic investments in the history of our company. A couple of those have been outsized wins. We've got some good ones on the books right now, including an operating gold mine in Western Nevada called Rawhide that we're quite pleased with. But a key one in our portfolio that we liquidated near the end of 2018 has put us in an extraordinarily strong position from a cash perspective. So we're here today thanks to the careful stewardship of our money and our strategic investing wins, with as much working capital, cash, and the value of our short-term investments as we have raised in the entire history of the company, in addition to over 200 mineral property positions on the planet. And on my screen, I can see the map of our assets across the world. We're prolific holders of mining claims and mining concessions in the Western United States and in Canada. We're the third largest mineral rights holder in Arizona, thanks to the execution of this business model. And we have substantial assets in the gold fields of Nevada. We're one of the largest mineral rights holders in Fennoscandia. That would be Norway, Sweden, and Finland. At this point in time, we're actually the single largest mineral rights holder in Norway and in Sweden, where we've had excellent deal flow in selling off gold projects, battery metal projects, copper projects for shares, work commitments, and always royalties on the back end. We've been in Turkey for 17 years. We have worked our way through over 250 properties there, and there's now 3 mines being built. Very importantly is the Balya lead zinc silver operation, which is ramping up towards full-scale commercial production towards the latter part of this year as we move into the first quarter. And then the company maker within our portfolio is our Timok royalty. This is a royalty covering a portion of the Timok magmatic complex in eastern Serbia, Europe's largest historic copper and gold producing area. We prospect generated these royalties early on in the history of the company, and then we augmented that with royalty purchasing in that district as well. And we have exposure to that world-class ongoing copper gold development story. It's one of the most significant copper gold projects in the world, actually. So all of these assets are in our pyramid, and this pyramid represents, the base of the pyramid being the very early stage assets. We work them up, we sell them, we get other people's money, other people's expertise from our counterparties, advancing those assets up with more and more of them bubbling up towards the top of the pyramid, creating more cash flow. And that's illustrative of this immense embedded optionality within the portfolio as discussed. We have significant geographic diversification with holdings in the United States, Canada, Sweden, Norway, Chile, Turkey. We even have royalties over a substantial percentage of Haiti, of all places, which we generated organically and sold off to Newmont Mining Corporation in a nice profitable transaction and kept a royalty on. From a commodity perspective, about 62% of our portfolio is gold. The bulk of our top line income is gold. but we do have substantial future royalty production from our copper exposure. Long term, we're very bullish on copper for a whole host of different reasons. And we have a growing exposure to different battery metals, including nickel, cobalt, and PGEs. From an asset class perspective, 66% of our portfolio are royalties and 31% are assets that we are marketing to the industry, where we're executing that generative model that I explained to you, in addition to a number of projects that are in alliance with major companies being advanced through regional strategic alliances that generate more royalties over time, and our strategic investing portfolio. So we have a whole host of different counterparties that we work with. Newmont Mining Corporation is a very important one. They operate or have operated in the past the Leeville operation that's now operated by Barrick as part of the Nevada Gold Mines joint venture. Newmont's also a shareholder in EMX Royalty Corporation. They own approximately 6% of the company, have been with us for a long time. We've done 6 deals in the past 4 years with RTZ, the largest mining house in the world. We love repeat business. We've got a great relationship with these major companies, and a whole host of junior companies as well, many of which we were co-founders of. And we would package up some significant assets, for example, in the gold line in Sweden, and put that into a company called Goldline Resources, backed by PI Financial, in exchange for shares, annual cash payments, and of course, a royalty on those assets. That's getting ready to go public. Many of these companies that we've helped found, we get seed shares in addition to the royalty, and then we're able to actuate that value over time. It's paid off very nicely for us. Management and directors and employees of EMX own about 15.5% of the stock on a fully diluted basis. Paul Stevens, who's a huge believer in this business model, has bought the bulk of his stock out of the public market. He's around 14%. Newmont's at 6%. Sprott Global, through their institutional accounts as well as their retail accounts, would accumulate up to being our largest shareholder, somewhere in the high 20% range, I believe. And of course, Adrian Day, you're on the list there, and we appreciate your support. We have about 92 million shares fully diluted, 84 issued and outstanding. And quite importantly, we're sitting here today with no debt, $58 million Canadian in cash, short-term investments from our securities portfolio of about $10 million, giving us around $69 million in working capital, plus our long-term investments that we have on the books that don't count as working capital, but are significant shareholdings in other companies that would push us up towards 80 million. So that amount of value there with no debt is greater than all the money we've raised in the history of the company, in addition to some 250 mineral property assets around the world. This is absolutely definitive that this combination of business model that we execute works and works well. We have ongoing cash flow from the Leeville royalty that is being operated by Newmont Mining Corporation. We have a significant share ownership in the Rawhide gold and silver mine in Western Nevada that is dividending out nicely to us. And there's a whole host of different recent deals that we've done. As I've said, there's been 50 in the last 2.5 years. Just recently sold the Queensland Gold Project, which was 46,000 hectares with a 2.5% royalty to Many Peaks Gold in Australia. There's a whole host of different examples. I won't go through them all. And we have a nice broad security portfolio, as I said, that is worth in excess of $10 million. We're quite active in the Western United States, where we're the 3rd largest mineral rights holder in Arizona, with multiple deals with some of the largest mining companies in the world, as well as substantial holdings throughout Nevada. And I believe we're now the 3rd largest claimant in Idaho. Idaho has an excellent gold endowment, and we're seeing excellent deal flow. As we're developing these assets, adding value, we're selling them off for a combination of cash, shares, and royalties. The business model works very, very nicely. Barrick is now operating the Leeville operation, and they continue to announce very nice new drill intercepts within and close to our 1% royalty footprint on the northern portion of the Carlin Trend. And that's a nice asset that we have on the books. It's paid over $13 million since we've owned that, and in my opinion, will continue to pay for many, many, many years into the future. Talking about embedded optionality within our pyramid, a great example. When you have 200 assets around the world, there's a lot of examples of optionality working in our favor. But one I like to point out is the Hermosa Taylor project being advanced by South 32. This is the project that Arizona Mining made a huge discovery on and sold to South 32 for $1.x billion a number of years ago. We have a 2% royalty on the extension of that high-grade mineralization to the south. And South 32 is currently drilling and advancing their understanding of our 2% royalty ground there. And we're very bullish with respect to that. And this speaks to the aspect of us being exposed to the advancement of these projects at absolutely zero cost to us. We sold that project many years ago for a nice block of cash and a 2% royalty. Sat in our portfolio for a number of years, and the next thing you know, there's a huge discovery being made. And there's multiple examples of that type of thing going on within our portfolio. We also do buy portfolios of royalties when we find them at attractive prices. As I've said, we're value players in this industry where there's a lot of momentum activity going on. And a good recent example is we bought 60 some mineral property exposures from a prospect generator, private gentleman, Perry English, as he was retiring. And this gave us a solid footprint into the Superior province of Ontario and Quebec. 40 of those 60 assets are now royalties, and we're in the process of selling off additional ones, creating more royalties as well. That portfolio will pay for itself in 3.5 years, thanks to the cash and embedded share payments that are coming in within that portfolio. I mentioned that we're one of the most significant, I believe we might be the largest mineral rights holder in all of Fennoscandia now, with a broad exposure to this fantastic geologic terrain, which is quite similar, in fact, to the productive regions of Canada. And we've had multiple deals being executed here with major companies as well as junior companies, focus on gold, copper, nickel, platinum group element systems as well. But one key one I would like to point out is in Finland, the company Palladium One continues to announce some nice drill intercepts within a large polymetallic palladium, platinum, gold, copper, nickel deposit called Kaukua. We have a 2% royalty that can be bought down to 1%. That 1% cannot be bought down and is not capped. And this is turning into a substantial discovery in Finland. And it's another example of that embedded optionality. Turkey, 3 mines being built on our projects there. I already mentioned Balya, lead, zinc, silver operation, 5,000 ton per day mill coming into full scale commercial production in the latter part of this year. As we move into the first quarter of 21, this will be a multi-million-dollar per annum cash flowing royalty for us. We're quite excited about it. It's a 4%er. Cannot be bought down and has no cap. But the company maker in the portfolio is our exposure to the Timok magmatic complex. With Xinjiang, the large state-owned mining company, having signed a memorandum of understanding with the Serbian government to fast-track the Brestovac discovery, also called the Timok project, into production. There are 2 zones there. We have a 0.5% royalty covering the entire license, both zones. And we expect the upper zone to go into production in the latter part of 21. And when they get into the lower zone, it's going to be phenomenal for us because the endowment of metal in this system is gargantuan. There is a historic resource quoted by the previous owner, and it is also documented on the Xinjiang website, of 1.7 billion tons at 0.86% copper and 0.18 grams per ton gold. You can do the math on that with respect to what a 0.5% royalty is worth. That's in addition to the high-grade upper zone that's going into production first. There are twin declines being advanced at this point in time, as well as twin shafts being put in. Xinjiang owns a smelter and a mill immediately adjacent on the Bor property, which they bought from the Serbian government. And this will be in production shortly and represents a key asset in the portfolio of EMX. So our strong strategic investing track record with a 40% internal rate of return on invested capital over our 17-year history has put us in a very good cash position. Our strategic investing has been a key aspect of how we've approached this business, and we think it's particularly synergistic with our bread and butter of royalty generation, approaching this business from a astute capital allocation mindset, as opposed to a mindset of paying whatever it takes to buy more royalties to continue to build that. And the integration of that royalty generation with royalty acquisition, we believe, is particularly powerful. And there's an immense amount of embedded incipient cash flow from these mines that are coming up and on the verge of coming into production. I'd like to point out that our compounded annual growth rate of EMX since the time that we went public at 30 cents till the time that till today, where we're trading around $3.50 Canadian, is around 17%. And this puts us in a very nice position comparatively to the rest of the mining sector. And we believe that we're undervalued today, particularly when you take into account the power of these royalties that are about to become cash flow within our portfolio. Whereas when we first came public at 30 cents, we were probably overvalued. And so I think that not only can we maintain the compounded annual growth rate of 17%, I believe we can improve on that. That's right up there with the long-term compounded annual growth rate of some of the major royalty companies in the sector. Adrian, my pleasure to be here today and happy to answer all the questions.
Okay, well, thank you very much, David. Sorry about the PowerPoint, but it was good to look at your pretty face and nice suit.
I can only imagine.
So I think everybody can see, why I like these three companies. They're all great companies. Two of them, in fact, for what it's worth, we bought before they were public. We bought as private companies, which shows you how much confidence I had in management. And again, for what it's worth, if anybody's interested, we have bought all three of these companies, all three of these stocks for clients today, yesterday, and all week. Every day this week, we bought each one of these three. So I think all three are still not only great companies, but the stock prices are at extremely good values. So let's open it up for discussion. I'm going to sort of throw out a question, but we'll lead to a discussion or questions. But the first question really incorporates a lot of different aspects, all related. Some of them have come from listeners, and I'm just incorporating that into the question. I guess the first thing is, there's a lot of new entrants in the space. Another one went public today. Are there too many royalty companies chasing, and too much money chasing too few royalties? And with the price of gold going up, obviously companies now have more options to raise capital, but are more attractive today than they were 3-4 years ago. So looking at all of that, are there still attractive royalties to be acquired? Who wants to go first?
I'm happy to answer that question, Adrian. My definitive answer to that is yes. And we're seeing royalties trade at very, very, very high valuations right now, and that's why we're focused on the generation of royalties, because we believe that's distinctly more astute allocation of capital. You really have to put on the thinking cap and understand the details of the engineering, metallurgy, and economic geology to find the assets that are appropriately priced in the current environment. But I will point out that it's been like this for a while now.
And if I could comment, I would say that, from where we sit, and obviously I think we have a very different business model than David's, which is obviously more, I think, as he explained, more generative. In where we're trying to position ourselves in terms of Nomad, the streams are also very important, which are very different than a royalty per se. Typically, unless you generate a new royalty from a project like David does on a regular basis, your only other option typically is to buy a third-party royalty from somebody else, from a prospector that held some ground and so on, that kept the royalty when he sold. So typically they come from third parties, and you try to find those. But in terms of our specialty at Nomad and what we've seen, the big guys do very well. I mean, Franco didn't go from a $15 share price to 200 just on the back of Gold Strike, even though that was probably the best investment they've ever done. I mean, they kept on using their multiple, reinvesting in new streams and new portfolios, and really added to their portfolio in sometimes very significant ways. And that stream component allows you to take, I would say, bigger bets than one, or I would say smaller royalties. The nice thing about the stream is that it comes through project financing as well. And, that's where I would say 15 years ago, when I first started in the business, when somebody wanted to start, a project financing, it was debt and equity, and you had two options. And if you preferred debt, you'd go, 60% debt or more, and then you put a bit less of equity. Now that the streaming structure, or royalty, depending on how you want to structure that, it's part of your project financing package. In most cases, because it's a very, very attractive cost of capital for the operators. You're seen as a partner, not as a lender. So that's something that's becoming more and more mainstream in terms of the operators. They see it as a very good source of capital, very good, and especially if you're even looking at a base metal opportunity where you're streaming off the precious metals, which obviously you're able to buy at a much better, or you're able to offer them a much better cost of capital than, say, the lenders that are looking at that operation. I think that's where you're seeing a lot more opportunities, and with that inflow of funds into our sector, it gives us more opportunities to do these types of deals. So I would say, as everybody explained their company, we all have different parts of where we invest, and I think that's why, as David pointed out, the structure, the financial instrument is proven, it works, but there's a lot of different ways and alternatives to invest in this sector.
And maybe just if I can build on that, and actually it's funny sometimes when you go back maybe 8 or 10 years and you look at the royalty sector then, and I think often I hear people say it's very crowded now, but actually if you go back to 2010, 2012, there were 10 or 12 royalty companies in the $20 to $500 million space that no longer exist. And all of those were acquired by some of the larger royalty companies. And so if you rewind 3 years and you see a number of new royalty companies coming to the market, from my perspective, actually, I see it as they were filling a gap that was created when those previous royalty companies that played in that space were acquired. And so it's interesting when you, I think, look at it from that perspective, that actually it's not so different today to how it was at that point. And there's a great presentation that I think one of the larger royalty companies gave in 2011, saying the rush to royalty and streaming, and talking about all the new entrants in the royalty and streaming market that had come in at that point. And so I think it just some perspective on that from a historical point. And I think that one of the great things about the royalty model and companies being so successful is that the larger royalty companies are looking at more material, larger deals as they grow that are still relevant to them. And when we set up Elemental, I remember one of my key concerns at the beginning was, is there going to be enough deal flow, and are the opportunities there? And there's a company that was listed in London, and they sold a project to a mid-tier miner and kept a royalty on it. And they wanted to sell that royalty and realize the cash, and they were a prospect generator. And they actually took it to a lot of the big royalty companies at the time and it was about a $5 million royalty, and they didn't get any offers from it because the bigger royalty companies were busy at that point doing $100 million, $500 million deals. And in the end, the only offer they got to buy that royalty back was from the operator themselves. And so it was a good example at that point when we were starting out of, okay, yeah, I think there is a really good opportunity in that where we started $2 to $20 million space, where we can do good quality, meaningful deals. And I think all the deals we have done today, bar one, were directly negotiated with the royalty owners. It wasn't in a competitive process. We weren't pushing the price down, competing with other people. So some really good value buys in the royalty space. Not easy, but there are opportunities out there.
Yeah, I wanted to, David obviously has an approach that's different from the others. Most of his royalties are through generation, through exploration, generating it, and it's, retaining a royalty. But I just want to make clear that it's been sort of discussed that there are other ways, two broad ways you can get a royalty. One is from buying an existing royalty, which might be a legacy royalty from a landowner, from decades ago, or creating a royalty because a company's looking for capital. And how do you see the differences and the advantages or disadvantages? Is there one you prefer to buy existing royalties, or do you prefer the royalty creation? Which one has advantages? Which can you get cheaper? Who wants to answer that?
Well, to be perfectly frank, I'm happy to be frank in my analysis of that. The growing them organically is the least expensive, but the Achilles heel of that is the very slow development. There's a long timeline between acquiring, staking mining claims and having a producing royalty. And so, but long term, that's the most astute allocation of capital, in my opinion, Adrian. But the Achilles heel is the slow payback. I would call it the get rich slow plan.
Okay. Vincent?
I would say that, obviously the difference when it was, you're kind of coming back to the project financing for a company in a way. The great thing about creating new instruments versus, I would say, generating new royalties from the slower process is when looking at streams, you can be very innovative in the sense that you can include an area of interest. So you might own something today, but you might say, you know what, I'm buying this today for what it is. But if you do, more exploration 5 kilometers away and it goes through the mill, well, let's include it. The thing with royalties is typically they're attached to certain claims or a certain area, and it's tough to get out of those, very specific terms. And obviously, for an operator that's looking to say, expand an operation, selling a royalty, which is 99% margin, is not as aligned as a stream. Or a stream are typically, between 65 and 75, or let's say 85% margins. You're at least able to, as an operator, you're at least able to cover a good portion of your operating costs through the transfer price. So when we're talking about alignments, we see our stream partners as being partners. So, if they do well, we do well. So I think it's a bit of a different component. To go back to your question, I think you need to play on both ends of the portfolio. Sometimes, we're very focused right now on, buying things that are near-term cash flow or in production, because we see a very nice, cycle in front of us. And we want to make sure that when gold prices go up, we're able to have those, those instruments that are cash flowing, that we're able to return that capital or reinvest it. But we're also looking on the optionality factor, which is more on green fields and, exploration type targets, where you're able to buy a royalty for a very discounted price and take that 10-year approach or that 5-year approach. But I don't have to sit in front of an investor and say, this asset is going to be in production in 3 years. I think that's where, there's a bit of a different approach when looking at different assets.
And I think also I think one of the key differences, at least from our perspective, has been in market conditions. If it's a bad market generally, I think creating a new royalty or a stream is a more attractive proposition for the operators. And I think conversely, if the market's relatively buoyant, good quality operators can raise money at attractive valuations and prices for their shareholders, then I think that's where the secondary market actually probably comes into its own a bit. And so, as an example, the last 3 years, the 6 royalties we've bought have all been third-party royalties. And we probably thought coming to the market now, we would, for the first time with more capital available to us, being able to use our equity, we probably thought we might do more, create more royalties and streams directly with operators. And actually, the market conditions being very good have meant that most of the things we are looking at now are still third-party opportunities. And they're third-party opportunities where maybe we talked to the owners before and gold was 1,200 or 1,300. And they said, I've held this royalty for 5 years or 10 years. Maybe I'll hold it for another 5 or 10. And now we can go back to them and say, look, maybe this is a good opportunity for you to take half of that royalty off the table and put it in a mix of equity and cash with us and keep the other half. So I think we're driven generally by, I think so far, market conditions. Bad market, we can go to operators directly and look at creating royalties. In a good market, it's a good trigger for some of the third party and private royalty owners to think about realizing some of the value that way.
Okay.
But I would say that, a good market, right now we're in a good precious metal market, but the base metals in certain areas, they're not having as good of a time. And that's the beauty of this model, is that you're able to look at other markets and say, you know what, you have a copper mine or a zinc mine or a nickel mine, but you've got this byproduct of gold and silver. And that's where today we're seeing a lot of, very good opportunities, because some of those, operators are looking to deleverage or maybe look at an expansion. And, we have the ability to play in the gold and precious market, but we also have the base metal side of things, which right now we're seeing a lot of activity from those types, who obviously have less of a market on the equity front, precious metal companies.
Yeah, I think
one of the other things about buying an existing royalty is you're stuck with that company. You're stuck with the royalties terms and conditions. There might be a cap. There might be a right to buy back. There can be all sorts of and you sort of touched on that with the amount of ground is covered. How important do you think terms and conditions are when you're looking at specific royalties to buy? Anyone?
Yeah.
I'd say it's one of the most important elements. And when taking as an example the royalties we bought, there's I think 2 or 3 of them that have been rewritten with the operators, actually to the benefit of both parties. Because if there's ambiguity in the agreement, it's not necessarily in either party's favor. It's almost better to forestall any issues, address it now, clarify anything that maybe wasn't clarified then. So I'd say that terms and conditions are crucial. But I remember there's a royalty and it no longer exists. It was bought back in Australia, but it was written in the early 1990s, and I think it had a clause in it that for every $100 the gold price went up to $400, it increased by 0.5%. And I was told a great story of how when they originally drafted it, the operators sort of, when they put the royalty in place, they said, well, this isn't worth anything. And the people buying it said, well, we'll pay you another $1 million to put that clause in. And they actually tried to sell the royalty back when gold was sort of $600, and the operator said, no, we don't need to. By the time the gold price got above 1,000, suddenly the operator was saying, well, there's a whole lot more area that's mineable, but this royalty has gone from 2% to 5%. And they had to buy it back at something like 15 times the price that they had sold it for, not including all the revenue the royalty owner had got. So actually, there are some very good old royalties that were written in when the price was $300 or $400 and had escalating payments as it went. And I think someone touched on it in a presentation earlier that sometimes in those scenarios, you might actually need to renegotiate it for the benefit of the operator to make it more economic. And making sure the royalty owner gets a return as well. Okay.
Couple more questions, if I may, and this one is a specific one from someone listening. We've seen a lot of, particularly with the larger royalty companies, they have actually bought or created large royalties, typically on very large mines, but with sometimes as low as a 1% return given current environment. Do you have minimum return expectations on royalties? And is there a minimum that you will accept? Anybody? Who goes first?
That has to do with the degree to which you factor in various aspects of optionality in your discounted cash flow analysis. And in the words, I was talking to Tony Jensen, the former CEO of Royal Gold, about this topic one time. And he said that he threw it out. He said, I think the discounted cash flow analysis is not a proper way to value royalties, which is an interesting thing to say. I was discussing that sentence with a financial analyst I have a lot of respect for. He said, well, what he's really saying is that people aren't putting in the right variables and knowing how to actually look at those variables long term with respect to valuing royalties. And this all comes back to this concept of optionality. So the reason why David Hartwell says openly he'll pay NPV 0 to buy a producing gold royalty in Nevada. And the reason why he's willing to do that is that he knows that he has embedded commodity price optionality, discovery optionality, engineering optionality, metallurgical advancement optionality, all of which are multiplicative. And so they've seen that pay off over time. If you accurately put those back into your formula, we need double-digit return on equity.
Yeah, and it
could be doing the deal.
I agree 100% with that. And I think the important thing also is when you look at an investment, you want to structure it over a long enough period. You want to make sure that, you hit, as we said earlier, like we live in a very cyclical business where you go through very, high highs and very low lows. And sometimes those lows are very long, as we've gone through the last 10 years. But if you're able to structure an investment and hit maybe one of those, or two of those years that are very, very high, typically you'll be able to get your payback instantly on just 1 year. So if you're able to bake in that optionality and hit that very high point, and after that you're everything else is gravy. So it's a matter of making sure that you're structuring a deal where you get a payback in a decent amount of time, and then you don't take too much undue risk. And then I would say the development time zone, that's the riskiest part for a royalty company, between the feasibility and the construction. I mean, that's the riskiest part. That's usually the one that is delayed as much as possible. If you're in the exploration phase, sometimes adding 1 or 2 more years to that phase, actually, you'll go from a 1 million ounce deposit to 5 million ounce deposits. You're actually still creating value, versus between that feasibility and that first production. Typically, when you're adding, years, that's because you're going through problems, whether it's financing, permitting, and so on. So that's the riskiest part of the business for us. And that's where, obviously, when you're doing large investments, you want to make sure you're doing risk-adjusted, buys.
Yeah, good point. I think this is the last question. It's a 2-part question. It also raises a few other issues, so take it where you want to. 2-part question. When you're acquiring a royalty, do you prefer to pay with cash or with shares? Mm-hmm. And when you're raising capital, do you prefer the dilution that comes from equity raises, or do you prefer to use debt? And do you like to raise money when you can, or raise money for a specific project when you need it? Who wants to go first on that? David smiling for some reason.
So I would say in our case, obviously, it's all about per share metrics. Depending on where you're trading, if it was 6 months ago when we were at 0.9 times NAV versus where we are today, obviously using our shares at that point maybe didn't make sense, versus where we are today, at a higher multiple. If you're paying something for, say, 0.9 or 1 times NAV and you're trading at 1.5 times, obviously on a per share metric point of view, it makes sense. For the larger investments, there's a reason why we have that credit facility. I would say that the main thing for us is that credit facility. Debt for us is not to be a permanent part of our, capital structure. It's a credit facility. We want to use it to buy things. Typically, if you look at the precedent transactions for, large royalties and large streams, you're always looking between 0.8 and 1.1 times NAV. So if you're trading at a much higher multiple, able to pull that credit facility for a short amount of time and then refinance in the market, say 2 or 3 months down the road at 1.5 times, multiple, you're creating some value. So that's the way we look at things. I would say that, having zero debt right now, if you take the Yamana portion, it's very much in the money. So we would say we have no debt. That's a great position to be in.
Debt free is the way to be.
Frederick, any comment? You're on mute, by the way.
I think it's a mix of it is pretty similar in terms of the mix of equity debt as appropriate. We on one of the royalty acquisitions we borrowed $4.5 million to make the acquisition. We used $500,000 of revenue to reduce the amount we had to raise. So we only raised $4 million. And that's one of the benefits of having cash flow from the outset and having been positive cash flow from the outset, is that as we go, we can reduce the amount of dilution that we give to shareholders. And I think that's the reason why we still have a pretty strong focus on advanced and producing royalties. And I think it's the reason why we have a pretty tight portfolio and management still having material interest. But yeah, I think some of the points that Vince made, I would agree as well.
Okay. Well, I think we've come to the end. Do each of you maybe want to give us, 20 seconds closing parting words of wisdom? David, you've always got wisdom.
I appreciate that. As the folks, smart folks here in the room today have pointed out, this is a cyclical business, but we all have businesses that are focused on a very accretive financial instrument. And the way for the shareholders to take advantage of that, in my opinion, is to use the cycles to your advantage rather than be used by the cycles, to borrow a phrase from Rick Rule, and buy the dips and hold the stock. These are accretive businesses. You want to be exposed to royalties. Buy the dips, hold the stocks.
I think someone told me
Vincent?
a few years ago, actually, that one of the best strategies to do would just be buy a cross section of the royalty companies. And if you're not an expert and if you're not able to do as much work as anyone else, you can go and look at a sort of broad cross section, and there still aren't that many royalty companies out there. And actually, across the board, I think, as Adrian touched on at the very beginning, they have performed very well. And I think that there's clearly a difference between the risk profiles and growth profiles for some of the smaller ones versus the majors. But I think, actually, even some of the biggest ones are continuing to, grow at rates that people probably thought weren't possible 10 years ago.
Yeah, I mean, the last comment on my front, I mean, this is a sector that, you're able to profit from very strong cash flow from exposure to the commodity you choose to be in. But I think most importantly, us as royalty companies, we're the ultimate long-term investors in these projects. Once we buy these royalties, we benefit from, increases in resources, increases in, if the operator decides to go and expand and increase throughput and so on, we benefit from that day in and day out. And I think that's really the force of this sector and this instrument. So, our job is to keep buying, new royalties and creating new royalties and making sure that we add to the portfolio and add volatility. Which for an investor, when they look at the mining sector, the royalties sector, probably, I still believe, should be part of everyone's portfolio because it gives you that stability and that exposure to the commodity, which is what the investors want. So, there's always times to maybe go into explorers and producers and maybe, shift your percentage weight in your portfolio. But I think core holding in royalties will always be a very good thing for investors. Great.
Well, those are actually great words to close on, I think. I think we've had 3 great presentations and a really good discussion. I really appreciate everybody coming. We are planning on doing more of these. So if people, you know, listening to this have any comments on how they would like to improve it, you know, please email in and let us know. Gordon, do you have closing words? It's your.
Yes. No, appreciate. Well, one, I appreciate everybody being on the show today. And some of you know, I started doing charts when I was 13. I'm proud to report I'm 70 and don't have to do them with pencils anymore. So I asked one of my chart guys, Clive Mon, to put together 3 charts for us this morning. So why don't we start with the first one, which would be, I believe, Nomad. So I'm not going to, for SEC reasons, tell you what I would recommend you do with this, but I think it's very positive, and you can read what Clive had to say. So I think that's positive. Let's go to the second chart, please. EMX, again, looks very positive here, and the support lines, volumes, all that good stuff. And any of you can reach out to Clive Mond at clivemond.com. He lives in Chile. I talk to him probably 3-4 times a week. And last would be Element, the new one on the block, so a very short time frame. And again, he's looking at a base being built here. So once again, thank everybody for coming on today. And I think I learned a lot. And we'll see where the next episode is. So from Street Smart Live in Puerto Rico, I'm saying goodbye to everybody. Thanks.
Thank you.
Thanks.